during the next year or so. And of course, all we've seen is tightening, and so the odds are high that economic activity during the next year will be disappointing. So happy to hear him talk a little bit more about lags, and that the Fed has to be cognizant about lags, and then also to hear him talk about rents and how rents, as they get into the CPI in particular, are lagging indicators. And he cited a number of measures that are rents or rent-like, one of them being leases and the rate at which they're turning over. And this is for real estate. And he noted that the rate of growth on a year-over-year basis is decelerating sharply. And that's because we're seeing other indicators like the S&P Core Insights, I think that's the name of it, measure of home prices, down 3 consecutive months in a row. We have not seen this. And we have not seen the depth nor the extent of declines in the housing market as measured by prices since 2008, 2009. So the only bad news is he's now saying, yep, the rates will probably go higher than we envisioned just a month ago. We don't think that's good news at all. And we also don't think it's going to happen, the 5% plus. The other thing to note is the balance sheet. The Fed's balance sheet is shrinking by roughly $93 billion a month. Now, there's a debate about what this really means, but the San Francisco Fed says that if you add that to where the Fed funds rate is today, which is roughly 4%, that tightening would be the equivalent of a 6.3% Fed funds rate, all other things equal. Now, already the yield curve, so the difference between short-term interest rates and long-term interest rates, is negative. It's unusual, of course, for long rates to be below short rates. And that what that usually means is that inflation and or real growth are going to disappoint or surprise on the low side of expectations. And we do think both will happen. But if we took that 6.3% equivalent Fed funds rate, so I would say I don't think that's going to result in a full-blown crisis, but for people who do need liquidity and would like to get their money out, that's a problem. So we found that interesting as well. So what are we dealing with in terms of showstoppers when it comes to the Fed? Well, still employment, and we'll talk a little bit about that in a minute when we talk about the employment report. Headline CPI, still not near 2%. Core CPI, not near 2%. And the stickiness of wages, again, from the employment report, we did get a higher than expected wage rate today. And it used to be rents they pushed against. But again, Chairman Powell started talking a little bit about how deceiving rents in the CPI and I would say PCE are. So let's talk about the employment report as we go through economic indicators here. Well, the unemployment rate stayed at a low at 3.7%, only 0.2 off its low from July and September. Non-farm payrolls were higher. The increase was higher than expected, 263,000, becoming quite weak. I think household always catches the turn in a cycle. And as you know, we think the cycle did turn as household employment was turning in March, and that we fell into a recession then. And probably revisions will cement the case for that. But right now, GDP for the third quarter did come out up. Now, a big part of the reason was imports collapsing as companies tried to clear their shelves of inventory. So that's not exactly a ringing endorsement of how strong the U.S. economy is. Average hourly earnings did increase 0.6%. The expectation was 0.3%. That took the year over year wage inflation rate up from 4.9% to 5.1%. And the Fed's definitely watching this. Now, a counter to that is this work week decline means that total income, so average hourly earnings is just an average, but total income, when you measure all the hours, is not as strong as that wage growth would suggest. And another manifestation of that is consumer credit. So consumer installment credit is going up dramatically. It has for the last 6 months, I think. And typically when the consumer is struggling, drawing down the saving rate, one of the, again, manifestations of that is not paying off the full balance or paying off much less than normal. That shows up as a decline in the saving rate and increase in consumer installment debt. So we are seeing that. We're also seeing on the consumer side record negative sentiment as measured by the University of Michigan, and it deteriorated again this last month. So we're back into the early 80s. The survey did say that inflation expectations for the next 5 years on average ticked up from 2.9 to 3%. And I think that's because that was in reaction to gas prices, which have since come down. Then on the housing front, we got a surprise, a positive. New home sales up 7.5% month to month, a position on that right now. We believe this recession is much more of a supply chain related inventory recession, and that it will clear up pretty quickly. Although, economic statistics are so lagged that come this time next year, we might still be arguing if we're still in recession. But we do think in that period, both inflation and interest rates are going to come down pretty dramatically. Inflation below 2%, and interest rates, I think, will be surprised. Jeremy Siegel thought that we would see 2% interest rates next year. I found that very interesting. We do see one market suggesting that this point of view is correct, and that's the bond market itself. Bond yields peaked on October 22nd, I think, at 4.3% and are now down near 3.5%. That's a pretty dramatic drop in the bond market. And the yield curve is now, if you look at the 2s to 10s, I think it's inverted by 77 basis points. Again, a very steep inversion given the level of interest rates we're at.